The story you heard about the 2008 financial crisis was about subprime mortgages, bad loans to people who couldn't afford homes, risky borrowers defaulting, and a housing bubble that popped. That version isn't wrong, but it's dangerously incomplete. The mortgages were just raw material, and what Wall Street built on top of them was a machine so complex that the people running it didn't understand it, so profitable that stopping it was unthinkable, and so interconnected that when it broke, it nearly destroyed the entire global financial system. The machine is still running today, bigger than before and more complex than before, operated by the same people with the same incentives and the same fundamental problem that caused the crash in the first place. This isn't a story about mortgages, and it's not about people making mistakes. Every person involved was doing exactly what the system rewarded them to do, and that's what makes it terrifying. When an entire industry realizes it can profit from disaster, when the people supposed to prevent crisis have every reason to ignore it, when the biggest players know they're too important to fail and act accordingly, you get 2008. Welcome to the real story, the one where nobody was actually stupid. Rewind to 2006, and the US housing market is on fire. Home prices have been climbing for years, people are buying houses they can't afford, and banks are lending to anyone with a pulse. None of that is the interesting part. The interesting part is what's happening in glass towers in New York, where traders and financial engineers are taking those risky mortgages, loans to people with terrible credit and no down payment and adjustable rates that will explode in a few years, and turning them into AAA-rated securities. The safest possible investment rating, the same rating as US Treasury bonds, given to packages of loans made to people who had already been rejected by traditional lenders. The question everyone should have been asking was how, and the answer reveals everything. A mortgage lender like Countrywide or New Century Financial would originate thousands of subprime mortgages. Loans with features designed to look affordable at first but become unpayable later, teaser rates and interest-only payments and negative amortization where the loan balance actually grows. The lender didn't care if the borrower could actually afford the house long-term because they weren't keeping the loan, they were selling it. Investment banks like Goldman Sachs, Morgan Stanley, Lehman Brothers, and Bear Stearns would buy thousands of these mortgages and bundle them together into something called a mortgage-backed security or MBS. Bundling risky loans together isn't new, and the idea is that diversification reduces risk because if some borrowers default, others will keep paying and it averages out. Wall Street didn't stop there. They took those mortgage-backed securities and sliced them into tranches, layers with different levels of risk and return, where the top tranches got paid first and were considered safe, and the bottom tranches absorbed the first losses and were considered risky. Then they did something brilliant and insane, taking the risky bottom tranches from multiple MBS deals, the parts that were supposed to absorb losses, and bundling those together into a new security called a collateralized debt obligation or CDO. They took the riskiest parts of risky loans and repackaged them into a new product, then sliced that into tranches, and somehow through financial alchemy and mathematical models, the top tranches of these CDOs built from the bottom tranches of subprime mortgages got AAA ratings. It gets worse. They created synthetic CDOs, derivatives that didn't even own the underlying mortgages but just bet on their performance, essentially side bets on mortgages, where you could have one actual mortgage and multiple synthetic CDOs referencing it. The leverage was staggering. By 2007, the face value of CDOs outstanding was over $4 trillion, and for context, the entire US GDP that year was about $14 trillion. Wall Street had built a shadow banking system larger than anyone realized, based on loans that everyone knew were terrible and everybody was in on it. Understanding how this happened requires going back to the 1990s, when two things changed that made 2008 inevitable. First came the repeal of Glass-Steagall in 1999, a Depression-era law that had separated commercial banking, taking deposits and making loans, from investment banking, trading securities, and underwriting deals. The idea was simple: don't let banks gamble with depositors' money, and for 66 years it worked. The Gramm-Leach-Bliley Act repealed it, and the argument was that American banks needed to compete globally, that modern risk management made the separation unnecessary, and that diversification across banking activities would make the system safer. The result was exactly the opposite. Banks became bigger and more complex and more interconnected, and they started taking deposits backed by FDIC insurance and guaranteed by taxpayers and using them to make increasingly risky bets. Second, derivatives were explicitly exempted from regulation through the Commodity Futures Modernization Act of 2000. Brooks Laybourne, who ran the Commodity Futures Trading Commission, had warned about the risks of unregulated derivatives, and she was shut down by Alan Greenspan, Robert Rubin, and Larry Summers, the most powerful economic officials in the country. They argued that regulating derivatives would stifle innovation, that the market would self-regulate, and that the people creating these instruments understood the risks. They were wrong on every count, and with derivatives unregulated and banks allowed to merge commercial and investment operations, the stage was set. The incentives made the rest inevitable. Mortgage originators were paid based on volume, not quality, so they didn't care if the borrower could pay, they just needed to close the loan and sell it. Investment banks were paid to package and sell MBS and CDOs. The more they created, the more fees they earned, and they didn't care if the securities were safe because they weren't holding them. Rating agencies like Moody's, S&P, and Fitch were paid by the banks creating the securities, and if they didn't give good ratings, the banks would take their business to a competitor, which meant the agencies were literally being paid to approve products by the people selling those products. Traders and executives were paid based on short-term profits. Bonuses were annual and stock options vested in a few years, so no one had incentive to worry about what happened 5 or 10 years down the road. Regulators were ideologically opposed to regulation, believing that markets were self-correcting, that sophisticated financial institutions would manage their own risk, and that innovation should not be constrained. Every single person in the chain, from the mortgage broker to the bank CEO to the regulator, was doing exactly what they were incentivized to do. Nobody was being irrational, nobody was being stupid, and the system was working perfectly, just not for the people living in the houses. Between 2000 and 2006, this machine went into overdrive. Housing prices were climbing. The Federal Reserve had cut interest rates to historic lows after the dot-com crash and 9/11. Money was cheap and credit was easy. Subprime mortgage origination exploded from about $160 billion in 2001 to $625 billion by 2005. Wall Street couldn't get enough mortgages to feed the securitization machine, so lenders lowered standards even further with ninja loans, no income, no job, no assets, stated income loans where borrowers just wrote down whatever number they wanted, loans with zero down payment, and loans where the monthly payment didn't even cover the interest. None of it mattered because as long as housing prices kept rising, borrowers could always refinance before the payments adjusted upward, and as long as the loans could be packaged and sold, lenders kept making them. The rating agencies kept giving AAA ratings to securities backed by these loans. Their mathematical models assumed that housing prices couldn't fall nationally because that had never happened in modern history, so their models showed that even if some borrowers defaulted, the diversification across geography and borrower types made the securities safe. It was circular logic. The models said it was safe because it had never happened, and it had never happened, so the models said it couldn't happen. Banks were leveraging up, with investment banks operating at 30-to-1 or even 40-to-1 leverage ratios, which means for every dollar of capital they had, they were borrowing $30 or $40. At 30-to-1 leverage, a 3.3% decline in asset values wipes out all your capital and you're insolvent. But this didn't worry anyone because the assets, those AAA-rated MBS and CDOs, were considered safer than safe. Some people noticed the insanity, short sellers like Michael Burry and Steve Eisman who saw the fraud and bet against it, analysts who wrote reports warning about the bubble, regulators at the state level who tried to crack down on predatory lending, but they were ignored or marginalized or actively opposed by the industry and federal regulators. There was too much money being made. In 2006, the financial sector accounted for 40% of all corporate profits in the United States. Finance had become the biggest and most profitable industry in the country, and all of it, every bonus and every profit and every fee, rested on a foundation everyone knew was garbage. Housing prices peaked in 2006. Then they started falling. At first it was gradual, a few percent here and there, no big deal because markets correct, right? But those adjustable rate mortgages with teaser rates were starting to reset, monthly payments were doubling or tripling, and borrowers who were barely making payments before couldn't make payments now. Defaults started climbing, subprime mortgage delinquencies hit 14% by early 2007, then 15%, then 17%. This is where the models broke because the models assumed defaults would be isolated, a few bad borrowers scattered across the country and easy to absorb. When housing prices fall, defaults cluster, and if your neighbor defaults and their house goes into foreclosure, it drives down your home's value. If your home value falls below what you owe, you're underwater, and if you're underwater and facing a payment increase you can't afford, you default too. Contagion, the thing the models said couldn't happen, was happening. Several large subprime lenders collapsed in early 2007, New Century Financial filed for bankruptcy in April, And Wall Street barely blinked because these were marginal players and the big banks were fine with their risk management and sophisticated models. They were not okay. In June 2007, two Bear Stearns hedge funds that were heavily invested in subprime MBS collapsed. The funds lost $20 billion. Bear Stearns tried to bail them out and couldn't, and the funds went under. That's when fear started creeping in because Bear Stearns wasn't some subprime lender. It was one of the 5 biggest investment banks in America, 85 years old and a Wall Street institution. If Bear Stearns had exposure to this garbage, who else did? The answer was everyone. Banks had been buying each other's CDOs. European banks were loaded with U.S. subprime securities. Money market funds held commercial paper backed by mortgages, and insurance companies had guaranteed CDOs through credit default swaps. The interconnections were impossible to map. Nobody knew who was holding what, and nobody knew how much exposure anyone had. That's when the crisis shifted from a mortgage problem to a confidence problem. In August 2007, BNP Paribas, a major French bank, froze redemptions on 3 investment funds because they couldn't value the assets. They literally didn't know what the securities were worth. Credit markets seized up, the commercial paper market where corporations borrow short-term to meet payroll and fund operations started freezing, and the LIBOR-OIS spread, a measure of bank lending stress, spiked. Banks stopped trusting each other because if you don't know what's on the other bank's balance sheet, and you don't know what those assets are worth, why would you lend to them overnight? The Federal Reserve started emergency lending. Central banks coordinated liquidity injections to keep credit flowing and keep banks lending to each other and prevent a full-scale panic. And it worked, barely. Through late 2007 and into early 2008, the system limped along with banks taking write-downs and some raising capital while the Fed cut interest rates aggressively. And then in March 2008, Bear Stearns collapsed for real. Bear Stearns didn't die from a lack of assets. It died from a loss of confidence. When trading partners and lenders think you might be insolvent, they stop doing business with you, your short-term funding dries up, and your assets lose value because nobody wants to buy them at fair prices. They want fire sale prices or nothing. It's a death spiral, and once it starts, it's almost impossible to stop. Over one weekend in March 2008, Bear Stearns went from Wall Street giant to roadkill, and JP Morgan bought them for $2 per share with massive government backing, while shareholders who'd held stock worth $170 a year earlier got almost nothing. The government's message was clear: we won't let a major investment bank fail in a disorderly way because the system is too interconnected and the risks are too high. They called this too big to fail, but then they changed their mind. On September 15, 2008, Lehman Brothers filed for bankruptcy in the largest bankruptcy in U.S. history with $600 billion in assets gone. Why did the government let Lehman fail after saving Bear Stearns? The official story was moral hazard. If you bail out everyone, you encourage reckless behavior. But the real story was probably confusion and miscalculation because Treasury Secretary Hank Paulson and Fed Chair Ben Bernanke thought they could manage a Lehman bankruptcy and thought the system could absorb it. They were catastrophically wrong. Lehman's collapse sent shockwaves through every financial market on Earth. The commercial paper market froze completely. Money market funds started breaking the buck and losing value even though they were supposed to be safer than savings accounts. Credit default swap spreads exploded, and stock markets crashed globally. AIG, the insurance giant, was on the verge of collapse after selling hundreds of billions of dollars in credit default swaps, essentially insurance on CDOs, without setting aside enough capital. When the CDOs started failing, AIG owed money it didn't have, and the government bailed them out with $182 billion. Why AIG and not Lehman? Because AIG's failure would have taken down every major bank that had bought insurance from them, and the counterparty risk was too concentrated. Within days, Washington Mutual failed, Wachovia nearly failed and had to be rescued, Merrill Lynch was sold to Bank of America in an emergency weekend deal, and Morgan Stanley and Goldman Sachs converted to bank holding companies just to access Federal Reserve lending. The entire investment banking model had collapsed in weeks. Congress passed TARP, the Troubled Asset Relief Program, authorizing $700 billion to stabilize the financial system. The government essentially nationalized Fannie Mae and Freddie Mac, and the Fed backstopped money market funds and began buying mortgage-backed securities directly. Globally, governments coordinated emergency interventions with the ECB, Bank of England, and Bank of Japan, flooding the system with liquidity and guaranteeing bank debt. The total amount of money thrown at the crisis is hard to calculate, but estimates range from $12 trillion to $29 trillion globally in loans, guarantees, and asset purchases. They prevented complete collapse, but at what cost? After the immediate panic subsided, the question became, how do we make sure this never happens again? And the answer was the Dodd-Frank Act, passed in 2010 with nearly 2,300 pages of financial regulation, the most significant overhaul of financial rules since the Great Depression. It created the Consumer Financial Protection Bureau, imposed the Volcker Rule limiting banks' ability to make speculative investments, required higher capital ratios, created resolution mechanisms for failing banks, and attempted to regulate derivatives. On paper, it addressed the problems, but in practice, the big banks got bigger. JP Morgan, Bank of America, Wells Fargo, and Citigroup all emerged from the crisis larger than before, having absorbed failing competitors, and in 2007, the largest 5 banks held 43% of all banking assets in the U.S., but by 2020 they held 47%. The concentration increased. Too big to fail didn't go away, it got worse, and the implicit government guarantee for major banks, the idea that they'll be bailed out in a crisis, still exists and is baked into credit ratings, funding costs, and risk management. The people who created the crisis largely walked away. A few paid fines and some lost jobs and bonuses, but criminal prosecutions were almost non-existent. Only one banker went to prison for crimes related to the crisis, one out of an entire industry that had engaged in fraud, misrepresentation, and reckless risk-taking on a massive scale. The executives at Countrywide who originated fraudulent loans saw no prison, the rating agency executives who gave AAA ratings to junk saw no prison, and the investment bankers who packaged and sold securities they knew were garbage saw no prison. Instead, many of them got bonuses and promotions, and some are still running major financial institutions today. The regulations have been steadily weakened, the Trump administration rolled back parts of Dodd-Frank, banks successfully lobbied to water down the Volcker Rule, and capital requirements are higher than before 2008, but the largest banks still operate with significant leverage. The most disturbing part is that the derivatives market, the synthetic CDOs and credit default swaps that multiplied the crisis, is bigger now than it was in 2008. The total notional value of derivatives globally is over $600 trillion, and for comparison, global GDP is about $100 trillion. The machine that nearly destroyed the global economy in 2008 is still running. It's just been recalibrated slightly. Fast forward to March 2023, and Silicon Valley Bank collapses, then Signature Bank, then First Republic. Sound familiar? SVB's failure was different in the details but identical in structure, with concentrated risk, poor risk management, a run by depositors once confidence cracked, and contagion spreading to other banks. The government response was emergency interventions, guarantees beyond FDIC limits, and central bank lending, the same playbook as 2008. The system learned nothing structurally, it just added more guardrails while keeping the same fundamental architecture. The next crisis won't look like the last one because it never does. In 2008, the trigger was housing and mortgage-backed securities, but the next one might be corporate debt, which has ballooned to record levels, or commercial real estate struggling as remote work empties office buildings, or sovereign debt in Europe, or derivatives tied to climate risk. The point is that the system is designed to generate crises because the incentives haven't changed. Bankers still get paid for short-term performance and still don't bear the downside risk of their bets. So if they win, they keep the profits, and if they lose, taxpayers absorb the losses. That's not capitalism, that's privatized gains and socialized losses. The moral hazard is worse now than before because everyone knows that if you're big enough and connected enough, you'll be saved. The Federal Reserve's balance sheet, the amount of assets it holds, went from $800 billion before the crisis to nearly $9 trillion at its peak. Money created out of thin air to buy bonds and mortgage-backed securities to support markets. Is that a permanent feature now, where when markets wobble, the Fed just buys assets indefinitely? If so, we're not in a market economy. We're in a system where asset prices are supported by central bank intervention and where risk is mispriced because everyone assumes a backstop. The 2008 crisis revealed something uncomfortable, that the financial system operates on a lie. The lie is that sophisticated risk management, complex models, and free markets will prevent disaster, but the people managing the risk profit from taking it. The models are built on assumptions everyone knows are false, and markets aren't free when governments guarantee the biggest players. 3 things to take from the 2008 financial crisis. First, incentives matter more than intelligence, and the people who caused the crisis weren't stupid, they were responding rationally to warped incentives. When you're paid to take risk but don't bear the consequences, you take enormous risks, And any system where profits are private and losses are public will eventually blow up. It's not a question of if but when. Second, complexity is a weapon, and the financial system in 2008 was so complex that nobody understood it completely, which wasn't an accident. Complexity hides risk, makes regulation harder, and creates information asymmetry that sophisticated players exploit. When someone tells you an investment is safe because the model says so, ask who built the model and what assumptions it makes, because complexity is often a red flag, not a feature. Third, the system doesn't fix itself, and after every crisis, there's a window for reform that then closes. The industry regroups, lobbies, waters down regulations, and returns to business as usual. Real change requires political will that outlasts the crisis, because without sustained pressure, the incentives reassert themselves and the cycle repeats. The warning the 2008 crisis left us with is that the next one is already being built. Somewhere in the financial system right now, there's a product that looks safe, generates huge profits, and is slowly accumulating risk that nobody fully understands. Maybe it's leveraged loans or crypto derivatives or something we don't even have a name for yet, but the structure is the same with short-term incentives, complex products, light regulation, and implicit government guarantees. The crisis in 2008 taught us what happens when that structure breaks, but it didn't teach us how to stop building it. If this changed how you see the financial system, subscribe, because we're going deeper. Next time, we're examining the derivatives market, the $600 trillion shadow system that almost nobody understands but everyone depends on. The 2008 crisis wasn't an accident. It was a preview, and the sequel is already in production.